Today's guest is Nathan McCauley, co-founder and CEO of Anchorage Digital, the first federally regulated crypto trust bank providing custody solutions for institutional behemoths like BlackRock and Cantor Fitzgerald. Nathan, welcome to the show.
Thanks. So happy to be here.
We're excited to have you. To start off, can you tell us what crypto in America means to you?
That's a fun question. So I think for me, we started Anchorage late 2017, early 2018, and the fundamental bet of Anchorage was that crypto among institutions was going to be very big in America. And it's actually funny because in 2017, I actually thought I was late to the game. I thought that it was too late to be getting involved, that a lot of the fundamental infrastructure had already been built. But it turned out that there was still a ton of growth to be had, particularly on the institutional side. And our fundamental bet was that would happen in America. So we didn't set up entities overseas. We didn't set up anything. We were just like, hey, let's make a high conviction bet on America specifically, and to be at the place where we are now in 2025, where that's very obviously happening. Crypto is becoming the epicenter of it. Really is America now, is a real validation of that early bet that we had made, and I couldn't be more excited to see what's happening in terms of the growth in America and the prospects moving forward.
So Anchorage was targeted pretty heavily during the prior administration. We can get into all of that, but you're saying you didn't build overseas. You guys stayed right here at home during that entire turbulent period.
That's right. I think to the degree we expanded all overseas, it was for clients that wanted additional services. So, for example, crypto is global. So over time, we have added additional offices, additional regulated entities. For example, we're regulated in Singapore under the Monetary Authority of Singapore. But that came kind of after we had already scaled and achieved success within the U.S.
Nathan, I know that you're from a tiny town in Indiana, like 150 people tiny. I grew up in a town that's like 3,000 people, and that was tiny. So I can't even imagine what your town was like. Everyone probably knows you, right? Mm-hmm. But how did you go from a small town to building a company at the forefront of crypto? What was that journey like? When
it's a town of 150, it's actually 168 for what it's worth.
Oh, okay. The population went up.
But one of the funny things is that you can do shorthand for the post office, and so my dad was the pastor of the church, and so you could write pastor. Economy, Indiana, and mail would get to us because that was just it was a one of one lookup there. So yeah, very very small town setup in where I grew up. I did also spend some time in a 2,000 to 3,000 person town, and so know that
bigger, much bigger.
Yeah, it's a little bit bigger, but time was slower in a sense, but I think relationships were deeper, and so I really like that. And one of the things I like to say is that if you spend time in small towns like that, one of the things that you actually grow up and figure out is that crypto is a small town. And so when you think of like the people in the community that you're actually a part of, when you're in the crypto community, everybody kind of knows each other. Everybody kind of knows what each company is doing, each person is doing. And so I think a lot of what you learn in that setup is like, hey, always be careful with your reputation, be careful with how you're known, always be good to everyone. These kinds of ideas that you learn in kind of small town America directly apply to, I think, at least what I feel like the crypto industry is right now, and likely will continue to be. And I'm sure that's actually true in a lot of other industries, that the small town dynamics actually dominate when it comes to industry and understanding and knowing everyone there.
Nathan, I want to dig into what you said about sort of choosing the route, sort of amongst your competitors. A lot of people, I think, would say that you chose the hard way, right? With Anchorage, you guys went OCC regulated. I want to get, into that process. But compared to some of your competitors like, Fireblocks and BitGo, which are, MPC solution or, a trust company, you guys seem to have really built that moat very successfully, kind of climbing up that hill. What was that choice like for you guys, and why go sort of the hard way? I mean, do you see that as an advantage for you now?
Absolutely. We definitely see it as an advantage. We see it that a lot of the institutional counterparties that want to come in now, they want to go with the most conservative, thoughtful offering. And so I think that's driving a lot of our growth right now is there's a whole set of new institutions in America that are deciding now that it's time to come into crypto. And so they show up and they're like, hey, among the set of potential service providers that we can work with, what is the most secure, the most regulated, and the most conservative that we can go with? And the fact that there is a national trust bank that they can work with leads them directly to us. And so that's been a big boon for us. But as you mentioned, it's not necessarily the easy path. There's a lot of kind of brick walls you have to go along in order to get there. From the very beginning of the company, even before the company was incorporated, we were researching, hey, what kinds of regulatory apparatus could we pursue, whether that was a state trust company. Spent a lot of time trying to get a custodial broker dealer, which that one actually might be coming around pretty soon to be possible again. And we kind of jokingly said, hey, maybe we should become a bank, but kind of dismissed that and didn't think that was actually ever possible. So the fact that we actually eventually pulled that off and we're actually able to get a federal trust bank was really exciting. It was really kind of a realization of something that at the time we only joked about. But now, like you said, huge number of the institutions that are coming in respect in a sense the like to call it the proof of work that we did there in order to get that charter and maintain it. And so they like working with us because of that.
I love that. Yeah, I think that's the meat. You know, if you're not joking about starting a bank with your friends, you know, you're obviously not trying hard enough.
Yeah, that's right.
What I guess just for our audience, you know, we're going to get pretty in the weeds pretty quickly here, and you know, custody is obviously a vitally important topic, you know, to the entire industry. Can you just dig into the differences between like what would a custodial broker dealer's license versus like a bank versus, you know, a state charter for a trust? Like just explain the rails there a little bit just for our audience. I think that'd be helpful.
The way to think about these is that any regulatory entity that you're going to get satisfies something for the entity itself and satisfies something for the client. And so when we thought about what regulatory licensing path should we pursue, our first thought was, what will our clients want? What will the institutional clients, what will they want us to be? And so the mechanism there is like basically what do they care about the most? They care about regulatory compliance and they care about satisfying their obligations. And so in particular, there's this rule called the qualified custody rule that many of the largest investment managers, somebody called a registered investment advisor, must follow the qualified custody rule. And so because they have to follow the qualified custody rule, that mandates that you have to hold with a qualified custodian. And so it's like, oh, okay, well, we need to become a qualified custodian. What does it take to do that? Well, by statute, it says banks or broker dealers. And so you're inevitably led to the path where you want to pursue a bank or a broker dealer license. And what actually ends up happening after that is a question of what kind of an entity do you form? Is it more based on securities type regulation and history, or more in terms of banking? I think now one of the biggest things that separates national banks from state trusts or from broker dealers is the bankruptcy remote structure of the assets. When the assets are held in a national trust, they legally cannot become part of the bankruptcy estate of the bank itself. And so for some reason, if Anchorage was to go insolvent, the assets held within the bank would never become part of the bankruptcy estate of the bank. It would be owned by the clients throughout that entire process. It would not be up to a bankruptcy judge to decide on that. This is not the case with state trusts, where with a state trust, it's kind of gone both ways. If you look at the history there, sometimes bank trusts have been resolved where the custodial assets become part of the bankruptcy estate, sometimes not. And so if you're really looking for certainty on the bankruptcy remoteness question, you go with a national bank, and that's one of the biggest rationales for us. Beyond that, the level of oversight that comes in, the level of the kind of compliance that has to get built there is really an order of magnitude bigger. So that speaks to conservativeness of clients and kind of wanting to know that there's a lot of processes and procedures that are underlying it. But I'd say the real crux of the differentiation is on that question of bankruptcy remoteness.
Am I right in thinking, Nathan, that for a crypto institution to be considered a bank, it has to accept dollar deposits?
So in almost all cases, that is true. Here, what you're talking about really is the difference between trust banks and banks, and so trusts hold assets in a way where they don't become part of the bank's balance sheet. Typical dollar banks, when you put a dollar in a bank, that becomes part of the bank's balance sheet, and they have a lot more flexibility and freedom to do what they want with it. It's an imperfect analogy, but think of a trust bank almost as a really complex coat check, which when you put your coat in a coat check, you were expecting to get back the exact same coat. You were not expecting to get back an equivalent coat. You're not expecting to get back a quote worth the same amount. You were expecting to get exactly the same coat back from that coat check. And so in a sense, national trust banks operate like that, and Anchorage does as well. When you put in Bitcoin into Anchorage, you get your own Bitcoin address, you get your own Ethereum address, you would get your own Say address, whatever the case may be. You put in those assets, and then those exact assets get returned back to you when you ask for them to be, say, withdrawn from the trust.
Got it. And are there any crypto institutions today that have like a regular bank status like that? Are there any crypto institutions that take dollar deposits, or is that something that the industry is working towards under the new administration?
Yeah, I think it's something that a lot of people are looking at and saying, hey, what if crypto entities were themselves able to become banks in the case of dollar deposit taking? And so right now, the way all this works is basically the same way that fintechs have worked for many years, even before crypto, where a fintech company will partner with a bank in order to get those banking services. That's how all the crypto institutions, in a sense, are crypto counterparties do their bank services, is they partner with a bank that does the dollar deposit taking part of it. And then those partnerships allow the client to have both crypto and dollars available in the same entity. I think this is an area where the federal regulators have indicated a lot of open-mindedness recently from the Fed, the FDIC, and the OCC, all saying, "Hey, we're interested in more innovation in this space." So I think we should expect to see more happening there, but still kind of early days for that, and seeing exactly how all that will play out.
Speaking of early days, Nathan, I know Anchorage has been around for a number of years, but it received its federal charter from the OCC back in January of 2021 under acting Comptroller at the time, Brian Brooks. If you could think back to that time, it almost immediately got caught in the crosshairs of regulators when you got hit with a consent order from the OCC and then debanked multiple times despite being a nationally recognized entity. Looking back on that time and all the challenges you faced, is there anything you wish you would have done differently? And how did you really navigate that situation? I know you talked about these roadblocks and everything else in between, but what was that really like?
Yeah, it's interesting. It all, I don't know if it's just like survivorship bias, but it all feels very bad at the time. To just be blunt about it, it feels bad to get a consent order. It feels bad to lose your bank account. I think one of my team members actually talked about it. Like any one of those events would have been a career defining event for a team in TradFi. It's a major event to have any one of those things happen, and we had them happening like every other week for quite a period of time.
Yeah,
and so it's tough, but we basically remained convicted that we were doing the right thing. Remained convicted that, hey, we built this thing to be the most regulatory compliant crypto counterparty that you could possibly work with, and we still believe in that mission, even if things get difficult, even if some of our banks, due to their relationship with their regulators, can't work with us anymore. We remained convinced that we were a good company for the world, and that there would still be more growth there. And in fact, we even all through say the Biden administration, we actually grew in terms of client base, grew in terms of revenue in each of those years. And so despite significant difficulties, we had a kind of consistent growth through all that time. And so it wasn't just our conviction, it was also the numbers that were showing like, hey, there's still a real desire for this kind of a counterparty, and we're going to be well positioned for that.
Nathan, there was a report from Barron's a few months ago that said that you guys at Anchorage were under investigation by the Department of Homeland Security. Now, when we were all in Toronto, we saw you speak on stage and you basically debunked this narrative. So why don't you tell us what happened there? What was the deal with that article? So you guys are not being investigated by Homeland Security?
That's right. We're not being investigated by Homeland Security. Look, we reached out after the article came out. We had our lawyers reach out to Department of Homeland Security, talk to them, and we've gotten confirmation that there isn't an investigation into us. At this point, I really don't have too much else to share on that one. It's like a little bit of a bummer that an article like that would come out that, we didn't comment on it. DHS didn't comment on it. So it's kind of remained a bit surprised that thing even ran, given its sourcing.
I think you said it was bullshit on stage, if I remember correctly.
Yeah. I mean,
you're allowed to
curse.
I said
it was. It's what some
we can curse on here.
What some people might call bullshit. So yeah, I think that's right. So yeah,
it's a legal term.
Yes. Yeah. Legal and technical term. That's right.
Nathan, I'm curious about. I want to get back to, I think, your sort of approach here. The way that you guys have gone has obviously given a lot of sort of corporate treasuries confidence in the model. They want to work with a reliable registered custodian. There's a very common phrase in crypto, not your keys, not your coins, right? And so there's this big distinction between the legal title to an asset and the possession of those keys. How do you guys at Anchorage think about working with clients on, you're obviously not just throwing multi-sigs out there, like sharding the keys and, hey, you're good to go. How do you guys think about this relationship between like the keys and possession versus like this legal title that's much more familiar to kind of TradFi and those sort of maybe corporates that you're working with?
Yeah. So I think the biggest thing here is that I fundamentally believe in this idea of not your keys, not your coins. And so when we think about the tech that we build, we think about the infrastructure that we build. It is all about maintaining that crypto ethos. When you're holding assets in a trust, they are your assets. It's somebody else is holding them for you, but it's not as if you have given the assets to the trust itself. And our tech represents that. The way that our tech is set up is that the client holds a set of devices that allows them to biometrically authenticate to Anchorage, and only in the presence of that biometric authentication from a quorum of our clients are the assets able to move. So we don't move the assets ourselves, except in emergency situations, we can't move the assets. And so in a real sense, we are, I'd say, as philosophically, legally, and technically close to you could be, I guess, in a sense. We are as close as you could be along all those verticals to having the clients holding their assets while still satisfying their regulatory obligations like the custody rule, qualified custodian, using a third party. And so we've, I think in a real sense, personified those values while still acting as a custodian to satisfy the obligations that our clients have to regulators. For example, RIAs are legally mandated to hold at a third party, so they self custody isn't allowed for them, and so there's all these use cases where you have to do that. And I think we've really taken the best of both worlds there, integrated them into an offering that people can really trust.
I don't know if you all have noticed this recently, but Avalanche has been on a roll. From FIFA launching their own Layer 1 on Avalanche, to VanEck unveiling the purpose-built fund to back ecosystem projects, the world is watching and building on Avalanche. Web3 gaming? Avalanche-based titles like MapleStory and Off the Grid have it covered. Finance? Avalanche has got that down pat too. Entertainment? Built for that as well. On top of that, starting in 2026, Sports Illustrated Stadium will be the first major sports venue to fully adopt blockchain ticketing powered by Avalanche. Backed by a strong network of builders and dedicated community, the momentum is accelerating on Avalanche for games, music, sports, finance, and more. Want to see how Avalanche is driving adoption? Go to avax.network and check it out.
I'm curious about the options there. You mentioned obviously Bitcoin is by far, the largest asset by market cap and was a first mover into that public market exposure and seems to be relatively easy. Easy is the wrong sense, but relatively straightforward to custody as an asset, right? You're not working with like an issuing team and there's, disclosure requirements that maybe don't apply to Bitcoin as an asset class. But as we go sort of further down the chain, you mentioned Ethereum, Solana, there's been some ETFs filed for Say, which I know you may have some interest in. Like, do you think as a custodian about the size or the volume that is available, like the supply of the asset? Like, how does it affect you guys as a custodian to work on some of the, I'll just say like smaller or less liquid compared to Bitcoin sort of assets?
Yeah, it's interesting. So as a custodian, at first blush, we should be able to hold Bitcoin just as safely as we hold, coin market cap coin number 3000. I don't want to pick on anybody. We'll just call it like number 3000, whatever it is right now. From a custody perspective, you want to safely hold that asset, and our view at Anchorage is that almost no matter what the asset is, you should be able to and allowed to safely custody that asset. And so in traditional markets, you have custodians that hold the NASDAQ and NYSE stocks just as well as they hold the pink sheets. And it should be kind of non-opinionated in that regard. When it comes to the topic of actually creating, say, ETFs around some of these products, the ETF product itself does require a certain amount of liquidity to be available in that product for two reasons. Number one, just like the proper execution of that ETF requires that a counterparty can go obtain a large amount of it and sell a large amount of it to create kind of safety of operations there. And there's also a question of like how much is it traded in order to have trusted market pricing. The regulators generally don't want the ETF products to be subject to market manipulation, and a healthy amount of trading volume prevents and can at least help prevent things like market manipulation there. And so there is there's been a theoretical question we've asked some of the issuers on, could we create day one ETFs? So on the day a token does their token generation event, could you also release the ETF? And that's an exercise to kind of figure out exactly how we could get there. I don't think it's quite at that level yet, and so you need to have some amount of trading volume before you can get there. But say purely on the custody side, we are unopinionated there on how much market cap that's trading volume a coin needs. In fact, a lot of what we do is we help protocol teams with their token generation event. And so the way to think about that is, when the token comes into creation, obviously there's no trading on it yet, but we are there for many coins on day zero of their chain, supporting them for custody, and many of the coins lately actually create the token inside Anchorage. So that's a kind of an interesting service that we've been rolling out called TGE as a service, that's been helping coins with their kind of primordial soup days before they come into existence.
For these TGEs as a service, or just token generation events in general, I feel like a lot of projects really want to launch tokens outside of the US. They don't want to be associated with the US in the past. And now some of these teams are saying, hey, we're American made. We're here. We're stateside. We have a token in the US. What is your take on this? Do you feel that there's going to be more TGEs stateside, or how do you kind of look at this from your side?
Yeah. So I think there's been a lot of innovation in the space really since Anchorage has been around 7-8 years. We've seen a lot of different incarnations of how you create a token. Anything from the Bitcoin example of a completely fair launch, no pre-mine, all the way to different mechanisms that people are using right now. So I think there's just a whole variety of different options that people are taking. And I think we're going to see even more innovation there. I think some of that innovation is going to lead to fully U.S. domiciled coins, where they will say, hey, the team's here, the infrastructure is here. We feel very good about maybe some of the safe harbors that are coming out of the SEC. And so we'll be able to create the whole, create and hold the whole supply within US based companies. There's even some discussions now of, say, overseas foundations possibly re-domiciling into the US. And so there's, I think, a lot of regulatory questions there. There's also a lot of tax questions that people are answering. But it's definitely something that I think is gonna happen. People are looking at the administration's goal to have this be the crypto capital of the world or the universe. I don't know exactly how they're formulating it, but with that as the goal, it's more and more likely, I think, that more of these teams are gonna say, hey, we're gonna generate our token inside the US and kind of live our entire life here within the US regulatory apparatus.
Bitcoin might sound complicated, but the Gemini credit card makes it simple. Use it like any credit card. Buy lunch, gas, or your weekly groceries, and you'll earn up to 4% back instantly in Bitcoin or one of over 50 other cryptos straight to your account. No annual fee, and right now you can grab a $200 Bitcoin intro bonus. It's the easiest way to start building your Bitcoin stash. Go to gemini.com/CIA to learn more. Terms apply.
Yeah, I think it's a really exciting time for new projects trying to figure out, their path in a go-to-market with this sort of new, hopefully regulatory environment, developing in the States. Obviously, sort of legacy L1s and sort of larger treasuries are figuring out their strategy as well. Say launched the US based, Say Development Foundation, and we've seen a lot on that sort of 501c4 side. I'm curious though, the Clarity Act seems to be imperfect at best, as we'll say right now, in addressing some of these concerns, right? You highlighted some of the tax issues. Maybe we'll get some of that out of the final version of the big, beautiful bill. And we can go into sort of stablecoin legislation, those other areas. But how does the language around clarity affect you guys as business right now? It seems like a lot of the talk of sort of asset classifications and custody is just putting that authority back in the hands of the SEC. You guys, of course, work very closely with the OCC. So where do you think market structure is going, and how does that impact, the Anchorage business?
Yeah, it's a fantastic question. I think the Clarity Act, in sharp contrast to Genius and Stable Acts, which I guess we'll get to later, Clarity is trying to solve a huge problem, and the huge problem of what do we do with this whole industry, and so it's necessarily going to have a lot more complexity to it. And so I think it's in some sense it's a more ambitious undertaking, which is great because there's like real tangible work being done across the House and the Senate, and really across both sides of the aisle, to help figure out everything that's going on there. Specifically to the questions around us, we have this very nice setup as a national trust bank where we can hold assets no matter what they are. We can custody stocks, bonds, equities, airplanes, art, really any kind of asset that has value. National trust banks are allowed to hold that. Now, to be clear, we aren't in the airplane custody business, nor are we in the art custody business, except for NFTs. But just generally speaking, we are given very broad custody powers in order to custody assets. And so whether it's as I mentioned, NFTs, whether it's some assets that might be considered securities, might be considered commodities, might be considered stable coins or currency equivalents, we're able to hold all of those. And so at the baseline custody level, almost no matter what happens with Clarity, we're still very well positioned because we'll still enjoy that same kind of broad applicability on the custody side. Of course, where things get more interesting is once these assets trade. how do these assets trade? How do these assets move? That's where the asset classifications that are coming out through Clarity are really important to understand, and infrastructure that gets built on top of those will dictate whether more people go for broker dealers, and maybe broker dealers could hold and settle digital asset securities, and maybe, given some of the comments that they're making now, might even be able to hold traditional assets as well. And so that might be a direction people go in. I think the other thing that's happening with Clarity that is pretty interesting is actually the question of market structure. What should the market structure be? Should exchanges still custody the assets, or should those concerns be separated into different kinds of entities? Back to what I was saying earlier about bankruptcy remoteness. Bankruptcy remoteness is a really wonderful feature to have when you hold your assets, that if they're held somewhere else, they're still yours and they're not part of the bankruptcy estate. The last 5 years in crypto have had a lot of people come to a real personal understanding of the bankruptcy remoteness questions once you start to look at some of the crypto counterparties, and some of them that have not had the nicest of ends to their businesses. So I think bankruptcy remoteness is one that we personally are pushing a lot for in the market structure bills and Clarity, saying, hey, if assets are held in a fintech, if assets are held in an exchange, if assets are held anywhere else, great, actually wonderful. It's great to have all that flexibility inside a single entity, but the legal structure under which they're held should be bankruptcy remote, and that would suggest that using a bank as the back end for a lot of that would make a lot more sense than some of the alternatives. And so that's one of the ones in Clarity that we're hoping gets resolved nicely, so that everybody enjoys bankruptcy remoteness of the way their assets are held.
President Trump also vowed to end Operation Chokepoint 2.0, and as a result, many of these banking regulators have rolled back restrictive guidance from the Biden years. Do you think these roadblocks have been removed, so to speak? And when it comes to crypto and banking and this specific sector, are there more hurdles to clear on this front?
Yeah, I think it's a good question. So what we saw through things like Operation Chokepoint, I think there was kind of two ways to look at that. The first one was as part of the regulatory practice, the examination practice at banks. There was a lot of skepticism towards any of the banks themselves working with crypto companies. And this is what led to some of the debanking, some of the offboardings that happened. And as you mentioned earlier, I actually had that happen to Anchorage. Many of my employees had that happen to them personally. And then you've also got kind of at the higher level, the policy level, which prevented more of the crypto companies from themselves becoming banks, from themselves pursuing these kinds of charters. And so I think what's going to happen here with the top of the house at the Fed, FDIC, and OCC being more willing to see more of the crypto entities coming to the table and saying, "Hey, we want to become banks. We want to become part of this industry." You're going to see more openness in that area. Now, I think what everyone should set very clear expectations of what that looks like. In the normal course of things, chartering a bank is extremely difficult. So the way to think about this is like, okay, some roadblocks have been removed, so it's now not impossible. It's merely very, very hard. So go back to where I started with.
One step up. Yeah.
we joked that maybe one day we would become a bank. And that was a joke because we understood how nearly impossible it is in the first place to put together the right amount of capital, put together the right amount of team, and charter a new institution. And so I think that's where we are now. That's where new participants maybe wanting to come into the space are going to have to deal with that inherent hurdle, it's significant. And I think that's right. I mean, the amount of trust that U.S. consumers and U.S. institutions put in entities that have bank in their name is significant. You have a certain amount of trust and respect that comes with that that is not to be taken lightly. And so I think we are absolutely, as Anchorage, we're welcoming to newcomers. We think there should be more. I actually just gave a talk at American Banker where I encouraged all the banks in the country to become crypto banks. So I'm excited for existing banks to add crypto as an offering, and I'm also excited for new participants to come in. But no one should take lightly how hard it is, and the expectations should be set appropriately, I think.
Yeah, I saw you did that keynote about why every bank needs a digital asset strategy. And for those of us who are not there, I would love to know kind of like, why do you think banks need this? And maybe it could tie back into kind of like the Bitcoin reserve side of things, or maybe it doesn't at all. I'm curious your take on this.
Yeah. And so basically my argument in that keynote was relatively straightforward to those of us within the crypto industry. I think there's three big trends that are happening within crypto that every bank should be paying attention to. The first one is Bitcoin. The second one is stablecoins. Third one is tokenization. So on Bitcoin, you have literally the U.S. government establishing a Bitcoin strategic reserve. You have a whole host of states looking at doing that as well, establishing their own Bitcoin strategic reserves. And then you have a bunch of public companies that want to themselves hold Bitcoin. This is obviously going to cascade further, where more and more of the American population, both of companies and of individuals, are holding Bitcoin and holding crypto. So that, as a baseline, means that you have your existing clients. If you're a bank, they likely have part of their financial life that is not within your financial institution. It's held in retail exchanges, or it's held in other places, and so you should understand that as an opportunity you have to come into Bitcoin. On stablecoins, look, stablecoins are an attempt to reconfigure the way the dollar works and make the dollar 10 times or 100 times better as a product. And every bank is in the business of dollar movement, dollar holding. And so they must look at stablecoins as a part of their strategy moving forward. And then finally, tokenization, where we take that idea from dollars one-to-one maintained on a blockchain and apply that to all the assets. The way I explained that was basically that, since the 30 Act, 34 Act, and the 40 Act in the kind of mid-century in the 1900s, you've had a steady stream of improvements to the securities settlement system. And that, I think it's the next phase of that chapter, is the tokenization movement, where we might be able to go from T+1 to T0, but we might be able to dramatically reduce settlement times. We might be able to maintain ownership completely on chain. And so basically my pitch to them was like, hey, look, everybody's going to own Bitcoin. Dollars are all moving on chain, and all the other assets are moving on chain. So you need to act now. Like, now is the time, and there's never been a better situation in the U.S. The White House is saying that they want everything in crypto to happen here in America. You will not get a better confluence of factors that are coming together than this. So start your crypto journey now. And then, of course, I put in the plug saying, hey, we can help. We can help you build out these systems. We can help you build out this. We can act as infrastructure for you. And so we'll be an enabling force for a lot of that movement.
Yeah, Nathan, I want to go back and ask about that point about traditional banks and how they're addressing crypto. You mentioned sort of the stablecoin legislation. A common pushback that we hear on the Hill from representatives on the stablecoin bill is that reserves are not as protected as like FDIC insurance, which we know is historically kind of dramatically underfunded based on the liabilities outstanding across the whole system, right? This became, if you're in tech, kind of a micro, sort of PhD for some of the people who were involved in the collapse of SVB and Silvergate. We saw what all those liabilities would look like, and we're very, aware of what it means for a traditional financial institution to collapse. It means that we're turning the money printer on, right? So when we talk about the role of stablecoins in sort of traditional finance and traditional banking going forward, how do you guys see that developing? And then how also do you just address with some of these institutional clients this notion that, FDIC actually protects my money, versus knowing that, if we're over collateralizing or doing proof of reserves for these stable coins, we're actually providing a safer financial instrument? Like, what are those conversations like for you guys?
Yeah. I mean, I think that it's a really interesting discussion to kind of dig in and help people understand what's going on with that. I think there's for many of us in the U.S., there's a certain comfort that comes from FDIC insurance. And unfortunately, I'd say for many of us, that's because we don't have bank accounts with deposits that are over the FDIC limit. Congratulations if you do have more than the FDIC limit in a bank account. But for very large setups that happen at institutions, or certainly that happen at stablecoin reserves, being backed with FDIC insured deposits is not necessarily that good compared to being backed with U.S. Treasuries. Take for example probably the highest profile depeg of a stablecoin was USDCs. USDC depegged during the SVB bank run because they had billions held in a bank account at SVB. And so I would claim that the one of the biggest weaknesses that we have actually been demonstrated in the stablecoin infrastructure was the banking institutions themselves. And so I think there's a real sense in which backing with bank deposits in the back end is worse than backing just with U.S. Treasuries. If you back with U.S. Treasuries, the bank is not lending those out on the back end. They are held in that kind of coat check setup, like I talked about earlier. You put in the treasury, you expect to get the same treasury back out. And when reserves are backed by hard assets that are not being lent out on the back end, you have a lot more safety there. Now, it's a somewhat worse business model for the bank. And so I think that's what probably drives a lot of the debate about this, is that, if you're a bank and you've taken a bunch of dollars, you can do stuff with them. But the stuff you're doing is risk. And I would tangibly argue that the reason banks have to be so regulated is because of how much risk they're taking on. It's a fundamentally risky business, and stablecoins are taking that fundamentally risky business and dramatically reducing the amount of risk in it, while also buying a bunch of U.S. Treasuries, which has positive downstream effects as well. And so I think it's going to lead to a lot of people reassessing risk trade-offs and their overall appetite for how to hold their assets. And I think as more people say, hey, I would prefer stablecoins because it's lower risk and it's actually easier to move them, and they're kind of more useful in a lot of different ways. That's going to drive a lot of popularity for stablecoins over the next decade.
Nathan, Anchorage, we mentioned clarity, we mentioned the Genius Act and the Stable Act. Something else I want to get into that is going to be heavily watched, I think, by industry in both of these bills is sort of the difference between state licensed and federally regulated entities and how that's going to kind of play out. Anchorage is obviously a federally regulated crypto trust bank, but you've got a state level license as well. You have a BIT license in New York, and then you've got the banks in Wyoming, right? The speedy banks, they also rely on the state level regulators. As this legislation moves through Congress, the Clarity Act, Stable Genius Act, whatever we're going to call it, do you think states' rights in crypto are being protected, or is it kind of getting crowded out in DC now as we move to a more sort of federal oversight, I suppose?
Yeah, so it's really interesting. We obviously benefit, I think, in the U.S. from the almost dual sovereign that we have within the banking system. I think there's a lot of incredibly interesting, tangible benefits that we get out of that, where we have an opportunity to have some states be more conservative, some states be more forward-leaning. So you mentioned Wyoming. I'd also say New York was innovative in really being first to the game with the BIT license. So I think there's a lot of benefit that comes from that setup, and I think a lot of the negotiating that's happening around Stable and Genius is specifically around that exact point, to make sure that we maintain the dual sovereign as we move things forward, and that is set against the backdrop of the historical precedent here, which the reason the OCC was established in the first place, it was established by Abraham Lincoln to deal with the issue of we have too many wildcat banks that are issuing different kinds of currency. And so literally the establishment of the OCC was to control the currency in a sense, so that we had one globally, not globally accepted, but kind of mutually accepted currency across the country. And I think that our view is that basically what's looking like is going to happen is that there's going to be a state licensing path, but some controls to make sure that there is parity from the state level to the federal level. And I think what that means overall is that there will be a kind of tacit advantage that will go to the federally regulated stablecoins because of the fact that it's basically they will in a sense be the standard for how these should be regulated, and the states will be expected to match the OCC standard. Therefore, I think many of the issuers will decide that OCC licensure makes sense because there's a lot of tangible reasons that you would prefer that. So I think that's going to be how it plays out. But it does look like the states are going to have still a big role to play in this area.
Now, you guys have a charter, right, with the OCC. We've mentioned that a couple times. But what's next for Anchorage? We talk about all these crypto companies looking to get the charters that Anchorage has. Are you hoping to obtain a Fed master account sometime in the future? And if so, what would that provide for you? And why does it matter for Anchorage to have something like that?
Yeah, it's a really interesting question. So we're at a broader sense looking at the opportunities that are going to happen over the next several years within crypto. Right now, we're strong in custody, we're strong in trading. We serve venture capital funds, family offices, sovereign wealth funds, kind of everybody holding a lot of crypto. We help them hold it and we help them trade it. Many of our kind of growth areas are around taking our system and making it available as a platform for others, a platform for banks, a platform for fintechs, a platform for large institutions. And so I think that's a big area of focus for us, is taking what we've built and making it available as a platform, say for a large GSIB bank to a regional bank. Inherently in all of those conversations, the question comes up about stablecoins. How do we build stablecoin infrastructure? How do we integrate with stablecoins for the future? And so we're building out a lot of stablecoin infrastructure in order to help there. A recent acquisition we did was the Mountain Protocol. And so we brought the Mountain Protocol team in. They actually joined Anchorage, and there's a lot of interesting stuff they're going to be building over the next several months and quarters that we're not quite ready to announce yet, but I think is going to be really pretty fantastic for a lot of the institutional use cases that are going to happen over time. In terms of regulatory strategy and licensing strategy, one of the interesting things with becoming an OCC bank is that you become a Fed member when you become an OCC chartered trust bank. And so we have Fed membership, which basically just means we're in the club. We can't do anything with that yet, but we are in the club. And so the question of would we look at applying for a master account and things like that is something that we're spending a lot of time on. I think it would be pretty interesting to look at stablecoins and how stablecoins could interact with a OCC issued trust bank that also has a Fed master account. And so we're doing a lot of brainstorming in that area. And I think it'll be kind of interesting policy questions to answer there if that's a desired path forward. So no news there yet, but we're looking deeply at it, and we're already members, so we're in the club. That's a hard club to get into, I hear. It is. That's right.
Just a quick follow-up. My understanding of a master account is basically once you get that, you have access to the Fed's internal payment system, right? You don't have to go through outside banks. You basically just have access to everything that they offer.
That's right. So there's a set of services that you can get from the Fed. It's actually kind of interesting. When you become a Fed member, they actually assign you an account representative. that tries to sell you on using their services. And so I never necessarily thought of it that way. I think a lot of people think of the Fed as a government agency, but they're also like they're trying to sell you on their services as well. And so you're right. You can get access to ACH rails, wire rails, FedNow. There's a bunch of really useful services that you can get from that, and which ones you opt into and how you use them end up being a licensing question. So which set of services do you want to use? How do you want to use them? And so it's necessarily an active dialogue with people at the Fed on exactly how you want to utilize those services. It's not as if you just kind of get in and then start using it however you want. You still kind of have a obligation to explain what the business model is, how you're going to do that safely, how you're going to do that, and make sure that you protect the sanctity of the payment system. So I would caution against thinking it's just kind of an all or nothing, but it is those things are available to you once you get the account.
Yeah, Nathan, I have a quick follow-up on a point you raised sort of earlier in the conversation around bankruptcy remoteness and the treatment of those assets. So you guys participated, or Rachel from your team, who shout out Rachel, did a fantastic job at the SEC roundtable on custody. Fireblocks, BitGo were obviously also represented there. And one of the more interesting takes that came out of that roundtable was, I believe it was the representative from BitGo, sort of making a statement that kind of blew the legal chats up a little bit on the role for custody in potentially preventing the collapse of FTX. And I think you kind of alluded to this a bit, but I was wondering if you could expand on what role exactly a custodian would play in kind of a large scale meltdown or bankruptcy like that. Like, how is there any merit to that? You know, could custodians kind of be these sort of levies that we need in those situations, or what are the mechanics of that look like?
Yeah. So before we talk about FTX, let's talk about like a typical fintech arrangement. In a typical fintech arrangement, you would hold your dollars. It would appear that your dollars are held at the fintech, when in fact they are held at a back-end bank that is holding them, and in many cases actually has a direct obligation to you, the end client, to hold your assets securely. And so securely and in a bankruptcy remote fashion from, say, the fintech provider. And so the idea there might be that some exchange could set things up such that they hold the assets in the exchange, but use a third-party custodian on the back end who has a direct legal relationship with all of the underlying clients.
So FBO accounts.
Yes, FBO accounts for benefit of, and then the way that would be structured is that the exchange then, two things would happen. In the case of the exchange going insolvent, or by the way, in the case of the underlying custodian going insolvent, all of those assets would be returned directly to the end owners, without getting tied up in the bankruptcy estate of the exchange or the custodian. So this is a big advantage. Second big advantage is that holding it in a third party prevents taking the assets and using it for your own purposes. And so just the set of things that you can do as an exchange are severely limited if you are using a third party custodian. This is why, frankly, the qualified custody rule exists within RAAs, because RAAs have a legal mandate to hold with a third party. And so we tend to think that if exchanges were set up in this way, crypto exchanges were set up in this way, where the assets were held remote from the crypto exchange, you could prevent bad behavior, and the underlying holders of the assets would have a far more legal claim to the asset instead of them getting held up in the bankruptcy estate for sometimes years or even going on decades in some of the worst cases.
Nathan, to wrap things up, a question we always like to ask our guests is, what is something that you are watching in DC that you think others should pay attention to, aside from everything we've discussed?
Yeah, I think a natural consequence of established under the Bitcoin Strategic Reserve, natural consequence of the U.S. wanting to be the crypto capital of the world, is that we should, over time, see a lot more acceptance of crypto assets from government agencies. So wouldn't it be cool if you could pay your taxes in stables? Well, it'd be a bummer because you're paying taxes, but at least you're paying with stablecoins. So what about paying for government services? So that's one that I think is going to be interesting to see over time is the full embrace of crypto, the full embrace of stablecoins. To me, suggests that many more of the government agencies should have this as a payment mechanism themselves. And so, we have some states that allow you to pay in Bitcoin and other things like that. And so I think the federal government adopting some of that would be a really interesting trend. And that's one of the ones that I'm hoping to see over the next several years.
Yeah, for sure. That sounds good to me. I would like to pay in stable coins if I have to pay, which I do. Yeah.
If we must. Yes.
Exactly. Yes. Well, Nathan, thank you so much for coming on today. It was a pleasure.
Yep.
Thanks,
for having me.
Nathan.
Thanks, Nathan.